Hello everybody, this is Patrick MontesDeOca with the latest Seeking Alpha report published on March 26, 2018. Gold broke out of its range. Is 1484 next? This is a quick summary of this report that was published in Seeking Alpha. The forecast we made on September 28, 2017 indicated that the targets for gold in 2018 were bullish and were in the 1386 to 1484 range. If we look at the gold market, we have been in a trading range until recently of about $50 an ounce. And we recently broke out of this trading range. The VCPMI is identifying that we have entered a level of supply in overbought conditions short term. The forecast that we made using the variable changing price momentum indicator on September 28, 2017 for the next year appears to have been validated. The forecast that we made on September 28, 2017 indicated that the targets for gold were bullish and that we were in the 1385 to 1484 range. This was the beginning of the 360-day cycle that began on September 28, 2017. If we look at the price action since the data, we can see that in fact this was a major bottom that occurred at the beginning of the 360-day cycle projection. When we look at the current price of gold, we can see that we have broken out of this past week into a high that we made on the June gold contract of 1356 using the daily chart. If we look at the energy that we saw in the gold market last week, the reversion to the mean is accelerating towards the sell 1 target of 1386 that we forecasted on September 28, 2017. This coincides with the 180-day cycle period which indicates that we could be looking at a short-term top in the market. If we come into next week and we are able to take out the 1386 level after breaking the previous highs resistance levels in the area of 1353 to 1370, this will accomplish the 180-day cycle of the first sell 1 level of 1386 of the 360-day cycle. The fact that when the market touches the first sell 1 level confirms that it has activated the sell 2 level at 1484, which we forecasted on September 28, 2017. As we approach the 1386 target, it is very strongly recommended that self-directed traders take some profits off the table. It might not be a bad idea to consider some short-term bearish strategies or strategies that will allow you to protect some of the profits that you have made so far before the reversion to the mean occurs. Gold broke out of its range. Is 1484 next? If we look at the gold market, we have been in a trading range until recently of about $50, and we recently broke out of this trading range. The low end of the range is in the 1304 level that was established on March 1st. We traded through the high of 1354 on January the 25th and broke out of this trading range, establishing that much higher prices are yet to come. The VCPMI identifies the extreme above the mean, and when it is identified, the reversion to the mean occurs 90% of the time from the sell 1 level and 95% of the time from the sell 2 level. As the market enters into this $100 trading range, we are tapping into the bottom of the range. The upper end of the range is 1484, which is a $100 move from the sell 1 level. The question is, are we going to accelerate on a close above 1385 into that 1484 level rather quickly, or revert back to test the mean first? More supply may come into the market. If we take into account the VC is identifying that we have entered a level of supply and that the market, by trading about this level of supply, is indicating that it is extremely overbought, the price might have gone beyond its value rate of velocity short term and exceeded it towards the 180-day cycle top of 1386. This is a strong confirmation that as we move into the 180-day cycle, the price is reaching the sell one level. This is a very harmonic between the price in time. This area is going to be offered as an area of supply, and we could see some large supply come into the market and cause the price to revert back down to the mean. It's not the time to raise interest rates. When we put into perspective the tremendous amount of chatter that is going on politically and economically on the national and global stages regarding interest rates, it is difficult to get a clear picture of how some of these policies might affect the world stock and real estate markets and the US dollar. It is my opinion that even though the government is producing data that appears to suggest that the economy is recovering from the Great Recession of 2008, when you look at the environment in relation to interest rates, debt, and the US dollar as a reserve currency depreciating in value even as the Fed increases interest rates, there are alarm bells ringing that indicate something dire is about to happen. The LIBOR rate is beginning to show that spreads are inverting as interest rates go up short term. Those spreads are going to invert and attract cash short term from the long end of the market. A lot of money seems to be moving into the short end of the yield curve with interest rates rising short term. It is increasing the risk of the 30-year bond market to maintain its integrity and price. As interest rates seem to be on the way up, we need to look at the government debt levels, the balance sheets. It is beyond me why the Fed would raise interest rates at a time of record debt. There is also a great deal of spending taking place. I believe that it is a recipe for disaster. If we were in the 1980s environment where interest rates were at 15% and Reaganomics came in, there was room to manipulate interest rates down. Such a decrease in interest rates added fuel to the economy and led to the economic growth that we had. With record low rates and a massive record debt obligation currently, an increase in interest rates is the last thing that should be done to help the economy. What we have now is inflation suppressed, in some sense as stagflation. Although we have seen inflation moving into the stock market, which has set record highs, and in Bitcoin as a consequence of the demand of money that is sitting on the periphery of the economy and is looking for a decentralized form of an asset that can take advantage of anonymity. Raising interest rates and threatening trade wars appears to be the last thing to do in such an environment. It could lead to hyperinflation sooner than we think. Interest rates rise. The US dollar declines. Since we begin to hear chatter about the wars, we have seen the US dollar begin to accelerate to the downside, even though we have seen a rise in interest rates and the expectations that there are more rates hikes on the way. That in itself is an indication that the market doesn't agree with the current government monetary and economic policies. Even though we are in an environment of rising interest rates, which should support the dollar continues to decline. For all intents and purposes, it is beginning to accelerate down toward the 80 target level that we have discussed on Seeking Alpha a few months ago. These policies and a falling dollar have meant that gold has broken out of its $50 trading range. Based on current beliefs about rising interest rates, a falling US dollar, and increased risk of trade wars, gold rises. The VC PMI for gold and the supply and demand weekly levels. As we come into next week, the VC PMI supply and demand levels that we published on March 23rd, 2018 give us a short-term picture of how we can trade these markets next week. Self-directed individuals can use these levels to manage their positions in the gold market. The first filter that the VC PMI uses is the 9-day moving average, which is at the 1340. With the market closing at 1356 on Friday, it is telling us that the trend momentum is bullish. You can also use this level as a pivot point, stop, or a level to protect your profits if you purchase gold below 1300 as indicated in our previous reports. The second filter that we use is the mean or average price of the VC PMI, which is the 1341. With the market closing about 1341, it indicates that the price momentum is bullish. You can also use this as a protective stop pivot point. However, if it closes below 1341, it negates this bullish price momentum for the coming week. The price almost matches the 9-day moving average of 1340. If you're a self-directed trader, use the 1340 as a trailing stop. You can use this price for any other trading in gold related instruments, whether in gold mining shares or the cash market, as a form of a hedge or an indication of a reversal of the current trend is taking place. You can also use it as a tool to help you manage the inventory of your portfolio and as an indicator of the direction of the market. Its implication is multidimensional depending on the type of trader or investor that you are. As we come into next week, with the market closing about 1341, it's identifying the sell 1 targets of the extreme above the mean to be 1370, sell 1, and 1385, sell 2, which is where you should take profits. This closely matches the 360-day target of 1386 that we published on September 28, 2017. This combination of time and price is a harmonic alignment that, if completed, identifies a 90% chance that the market will revert back towards the 1340 area and test the weekly and daily moving averages. The VC PMI can also be used to analyze other markets, including 21 other markets we are currently produce reports on. We analyze gold and silver on Seeking Alpha to provide you with a taste of the power and possibilities of the VC PMI automated artificial intelligence algorithm. If you would like to reach us, you can contact us at 805 area code 418-1744 directly, or please feel free to send me an email, support@ema with the digit number 2trade.com. That's support@ema2trade.com. Once again, this is Patrick MontesDeOca. Until next time, my friends, be well, take care, good trading.